The 1970s began with a promise. After the turbulence of the 1960s, many people in the United States and other rich countries expected steady growth, stable jobs, and rising living standards. The post-World War II boom had created a kind of golden age. Factories hummed, wages rose, unemployment was low, inflation was modest. But by the end of the 1960s, cracks were appearing. Governments were spending heavily on social programs and, in the US, on the Vietnam War. To help pay for this, some governments ran large budget deficits. Central banks kept interest rates relatively low for too long. Prices began to creep higher. In the United States, inflation moved from around 1% in the early 1960s to over 5% by 1970. In the United Kingdom and several other advanced economies, the pattern was similar. Rising prices worried households and businesses, but policymakers were slow to react. They feared that raising interest rates too much would slow growth and increase unemployment, so they tried to balance between fighting inflation and keeping the economy moving. That balancing act soon became impossible. In 1970, the US entered a recession. It was relatively mild compared to what would come later, but it sent a warning signal. Growth slowed, unemployment rose, yet inflation did not fall as much as expected. This was uncomfortable, but still manageable. Then, in 1971, a major change reshaped the global financial system. President Richard Nixon announced that the US would no longer allow foreign governments to exchange dollars for gold at a fixed rate. This ended the Bretton Woods system of fixed exchange rates tied to gold. Currencies began to float more freely. The dollar's value became more uncertain. Commodity prices, including oil, became more volatile. At first, many people did not realize how important this change was, but it removed a key anchor that had helped keep prices stable for decades. The world was moving into a new era, an era of more flexible money, but also more uncertainty. And soon, that uncertainty would turn into a full-blown crisis. The new era of uncertainty did not stay calm for long. In October 1973, a geopolitical crisis changed everything. Following the Yom Kippur War in the Middle East, oil-producing nations in the Arab world imposed an oil embargo on countries that supported Israel, including the United States and several Western European nations. Oil exports were cut, production was reduced. The price of oil, which had been relatively stable, surged. In just a few months, the price of crude oil roughly quadrupled. This was not just a problem for energy companies. Oil is a basic input for almost everything: transport, heating, plastics, chemicals, and electricity. When oil prices jump, the cost of producing and transporting goods rises across the economy. For households, it meant higher gasoline prices, higher heating bills, and higher prices for many everyday items. For businesses, it meant higher costs and lower profits. The oil shock hit the United States, the United Kingdom, Japan, and many other advanced economies at once. In the US, long lines formed at gas stations. Drivers waited for hours, only to find stations running out of fuel. In the UK and Europe, similar scenes played out. Governments introduced rationing measures and speed limits to conserve fuel. The economic impact was severe. Higher energy costs pushed inflation even higher. In the United States, annual inflation climbed into the double digits by 1974. The UK and several other countries saw similar spikes. At the same time, the sharp rise in costs slowed economic activity. Factories cut production. Investment fell. Consumers, facing higher bills, reduced spending. In 1973 to 75, the U.S. entered its deepest recession since the Great Depression. Real GDP contracted. Unemployment rose sharply, yet inflation remained stubbornly high. This combination of stagnation and inflation became known as stagflation. It confused many economists and policymakers. Traditional economic models suggested that high unemployment should come with low inflation and strong demand with higher inflation. But the 1970s showed both high unemployment and high inflation at the same time. Stagflation was not just a statistical curiosity, it was a painful reality for millions of households. Workers faced layoffs or reduced hours. Families saw their grocery bills rise. Savings lost value as prices climbed. In the UK, the situation was especially difficult. Industrial disputes, power cuts, and very high inflation created a sense of crisis. At one point, the government urged people to light only one room and wear more clothes to save energy. The 1970s were no longer just about a single recession. They had become a decade of economic instability. Growth was weak. Inflation was high. Confidence in policymakers was falling. And the worst was not yet over. By the late 1970s, many hoped the worst was over. The mid-1970s recession had ended. Growth had returned in the United States, the United Kingdom, and other advanced economies, but inflation never fully disappeared. Prices continued to rise faster than in the post-war decades. Wages tried to keep up, but often fell behind. Households felt stuck in a cycle of rising bills and uncertain jobs. Then, in 1979, another shock hit. Political upheaval in Iran led to a sharp drop in oil production. The Iranian Revolution removed the Shah from power. Oil exports from Iran nearly stopped. Soon after, Iraq invaded Iran, prolonging the disruption. Once again, global oil supplies tightened. Once again, prices surged. The second oil shock was not as sudden as the first, but it lasted longer. Oil prices roughly doubled between 1978 and 1980. For consumers, it felt like the nightmare had returned. Gasoline prices jumped. Heating costs rose. Businesses faced higher energy bills again. In the United States, inflation climbed above 13% in 1979 and approached 14% in 1980. The UK and several other countries saw similar patterns. Confidence in economic management collapsed. In the US, long gas lines reappeared. People waited for hours, sometimes overnight, to fill their tanks. In the UK, high inflation and industrial unrest created a sense of national decline. Strikes affected factories, public services, and transport. For many voters, the 1970s felt like a lost decade. Policymakers tried different approaches. Some attempted wage and price controls. These temporarily limited how much prices or wages could rise, but controls distorted markets. Shortages appeared. When controls were lifted, prices often jumped even higher. The underlying problem was not just oil. It was years of loose monetary policy, large budget deficits, and rising inflation expectations. People began to expect high inflation. Workers demanded higher wages to keep up. Firms raised prices to cover higher wages. A wage price spiral took hold. Breaking the spiral required a painful choice. Central banks, especially the U.S. Federal Reserve under Paul Volcker, decided to prioritize fighting inflation over short-term growth. Interest rates were raised sharply. In the U.S., key rates reached levels not seen in modern history. The goal was to convince households and businesses that inflation would come down and stay down. The policy worked in the long run. Inflation eventually fell dramatically in the early 1980s, but the short-term cost was severe. A deep recession hit in 1980 to 82. Unemployment rose to its highest levels in decades. Many businesses failed. Households suffered. Yet this painful adjustment marked the end of the 1970s crisis era. It closed a decade defined by oil shocks, stagflation, and policy mistakes. And it opened the door to a new period. Lower inflation, more independent central banks, and a different kind of economic risk. The 1970s taught a hard lesson. Easy money and political shortcuts can create temporary comfort, but over time, they can lead to high inflation, weak growth, and a loss of trust. When the 1970s began, the future looked bright. When the decade ended, the future looked uncertain. But the response to the crisis set the stage for the next chapter in economic history. If you found this explanation helpful, tap the like button and subscribe for more simple breakdowns